Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Thursday, March 19th. We are kicking off the show today with some exclusive reporting. The Information revealed that a rogue Meta AI agent triggered a major security alert inside the company. I will talk to the reporter who broke that story about what she knows. We'll also talk about how you can be using AI agents yourself and how one power user thinks about the security risks and where the future of the AI-powered consumer is headed. We'll then shift gears to a new column in the Information published today about why Canva was smart to hold off on an IPO. I'm also speaking with one of our show's sponsors, Nebius. The company is coming off a whirlwind news week, including a $4 billion debt raise and two major partnership announcements. And finally, we will wrap the show with a conversation about the $5 billion debt drama around Qualtrics this week and a discussion about how software debt is trading more broadly. It's going to be a fun show, so let's get right on into it. Meta has been pushing hard on its AI agents roadmap. It has also been using them internally, but a new exclusive report from the Information reveals that Meta agents have triggered security issues within the company. I want to bring on Jyoti Mann, our Meta reporter, to share more with us what she knows. Jyoti, welcome to the show. It's great to have you here.
Thanks for having me.
So, what is going on over at Meta with these AI agent security issues?
Right, so at Meta Platforms, an internal agent was used by an engineer to help answer a technical question posted on their internal forum. Now, the engineer asked the agent to analyze the post. That in itself isn't unusual. Companies are increasingly deploying these agents in a way to boost productivity. But the key issue is that the agent didn't just analyze the problem, it acted without authorization. So it posted a response without approval, and another employee, trusting that response, followed its advice. Now, that triggered a chain reaction that led to internal systems which contained sensitive company and user-related data being exposed to employees who weren't authorized to access it for nearly 2 hours.
Wow.
What happened here is a really telling example of how AI agents are changing the risk landscape inside big tech companies.
Okay, so I just want to understand the timeline here. So basically, so somebody at Meta said, "I'm going to use an agent to analyze some sort of a post or a data set."
So it was a post where somebody had written a question and had a
Okay,
query,
okay.
and the agent responded
So
with a
the
question.
agent responded, and I mean, look, that's bare minimum. What agents are supposed to be able to do nowadays is analyze any kind of data, let alone a post. But then what happened is the agent took action without the person's permission. Again, this is kind of funny to me because that's sort of what agents are advertised as doing, is taking actions. I know you're supposed to give them the green light, but in some ways you could say the agent kind of did what it was supposed to do.
In some ways, yes, but when it's acting without approval, it means that it's triggered an event which couldn't have happened unless the agent had responded.
Right. So, okay, so the agent takes some action, and what was the action that triggered the security alert? Was it just the fact that the agent was doing anything at all?
It was the fact that it had provided advice which turned out to be incorrect, and that advice was acted upon by another employee.
Got it. Okay. So the employee basically fell for it. I mean, the agent said, "Here's what you might consider doing." The employee did it. And when a security alert goes off inside Meta systems, I mean, what are the repercussions of this? How serious is it?
So it was serious, but it wasn't catastrophic. Meta internally classified this as a Sev 1 incident, which is one of the highest levels of security they use. So that tells you just how, this company saw this as a major security event. Now, importantly, Meta says there's no evidence that user data was misused or accessed improperly in a harmful way during that window. So this wasn't a breach in the traditional sense. Nothing was leaked publicly, and there's no indication of abuse, but the risk was real. For nearly 2 hours, systems that have been tightly restricted were left accessible to people who shouldn't have access. Now, in security terms, that's a near miss of a worst case scenario.
Now, we know that Meta acquired the agent company Manus, which was a highly advertised acquisition that they did, and they are pushing ahead with their agent strategy. Is this a reflection of how well their agent strategy is working, or is this an issue that is common to tech companies when they experiment with tools like this?
Well, this episode really raises questions about whether Meta or other companies have really fully integrated the safety, alignment, and governance layers needed to manage these systems at scale.
Okay. And other tech companies have had similar such issues?
Yes, that's right. So we've seen that happen with Amazon Web Services. An agent assisted coding change led to a 13-hour outage in a cost calculator tool in December. And more broadly, companies are experimenting with agentic tools like OpenClaw and have reported agents ignoring instructions or taking unintended actions. But
So let me go ahead. Go ahead.
Meta has also announced in December that it's acquiring Manus, which is a Singapore headquartered AI application startup that was founded in China. So, what Manus actually does and why Meta wants it comes down to AI agents. It focuses on building agent style AI systems that can plan, decide, and execute tasks across different tools and environments.
So, what are the big reporting questions that you have from here? Now, we have this incident. We think Meta has taken action to rectify the issue. Presumably, it's still charging ahead with agents. You just mentioned the Manus acquisition. What are the big questions that you're trying to get answers to right now?
Well, firstly, how widespread is the use of agents inside Meta? Was this a kind of a one off incident, or are there other near misses that haven't been disclosed? And one thing I'm really curious about is what guardrails actually exist today in companies like Meta. And I think the biggest final question is, are companies moving too fast in deploying autonomous agents in critical systems?
Great. Well, Jyoti, I want to thank you for coming on. That is Jyoti Mann, our Meta reporter here at The Information. Whether it's figuring out which AI tool to use or figuring out what platform to consume your content on, there truly has never been a crazier time to be a consumer and a user of technology. I want to bring on Brit Morin, co founder and managing partner of Offline Ventures, who has backed a number of companies in these categories over the years. Brit, welcome to the show. It's great to have you here.
Thanks for having me. Great to be here.
So you posted on LinkedIn yesterday about your daily workflow with AI agents, and I want to get you to unpack it in a second here. But the broader question I do have before we get there is we just had our Meta reporter on before you, and we were talking about some of the security risks that can come with AI agents. And so my question for you is, I mean, you're using all these agents. Does it not scare you, these security concerns at all?
I think that there's definitely a concern for security with in everything agentic right now. And of course, the big debate this week is all around OpenClaw versus all of these other agentic models and whether you're hosting your agent locally or in the cloud. And frankly, OpenClaw has been the open source platform that's gotten the most hated on, I guess, for security issues. And Jensen this week flat out said, we are creating a secure version of OpenClaw for the enterprise. We're going to run it through NVIDIA using NemoClaw. And that really caught fire across so many different communities. And so, one thing that I do think is really interesting about OpenClaw is that you can't, and sort of where the future is going with these local models is that you can host them on your devices in your home, in your office, on your desktop, and not worry that your data or your client's data is actually going into the cloud. So for those reasons, I think that we are actually creating a future that will be more secure versus less secure.
Have you had any experiences with agents taking unintended actions or some surprising results that you've
I
woken
have
up to
not had
saying,
any agents delete my email yet. No. And I will say, like, let's be honest, like this, we're at the forefront of all of this, right? Frankly, security is like one of the biggest concerns right now from everyone in the community. It's part of the enterprise race that now OpenAI, of course, is leaning deeper and deeper into alongside Anthropic and everyone else. And so I do think that you're going to see a number of security protocols starting to launch and these things just getting really, really tight. But I would be cautious if you are connecting your email and a bunch of sensitive information to anything right now. Make sure that you're doing it with a brand new trust. There's so many spin-off things going on, and I do think that there's certainly right for concern.
are your kids using agents at all? Are they
Oh yeah,
making any of these?
my son, my 11-year-old, has fully vibe coded his first app. It's a game. It's called Tide Shift. And he is submitting to the App Store this week. But with Apple and all their vibe coding, issues right now and App Store delays, we'll see how long it takes to get
I
it
was just
live.
gonna say, I was like, let him know that son,
Might
there's
be a
just a little
month or
more going
two.
on.
Exactly. Yeah, we'll see. We'll see when Apple approves this thing.
So, look, I want to pivot to a slightly different topic. We saw news this week that Meta is incentivizing creators now to post on Facebook. And, I was actually reminding myself of the relative sizes of the user bases on Facebook versus Instagram. I thought at this point Instagram would be bigger. It's actually not. Facebook is still larger. And yet Facebook is not the platform that we think of when we think of creators. I mean, I wondered what you made of this move and whether or not you think that Facebook could become a creator hub the way that we think of other platforms as?
Listen, I've seen Meta slash Facebook try this move many times in my career, having run a digital media company, Brit and Co, for several years. There were many different times, whether it was Meta or TikTok or name your plot, Google, like they offered publishers dollars to be the first to post all their content first, to at least syndicate their content on all their different platforms. And OpenAI even started doing this right in the early days when licensing from different publishers. I think this is always a trap. There's a reason why they want your content. They think that you think that you're going to get paid out all of these dollars, and frankly, you're at the mercy of these platforms to change their mind on a whim. So I don't think it's a sustainable business model. A, if you are a creator and you're banking on this being like your big break, and B, like, is this really the return of Facebook? I don't think this is where creators will end up permanently. No, I think creators are always on the forefront of culture. They want to go to what's new, what's shiny, what's hot. Sure, they'll syndicate content in lots of places, but when they're building content, they're thinking about, what is the platform where I'm going to get the most distribution from the eyeballs that matter most to me? And most creators are younger people. They're going to trend towards the younger platforms.
And so is the strategy here, if you don't think that this is a play I mean, look, they're trying to get creators on the platform, but I guess what I'm wondering is there a broader strategy here? Is there, we know that Meta's ultimate ambition now is this personal super intelligence. I mean, do you conflate this play with that play at all? Are they related?
Do you mean in the sense of getting
Yeah, I
getting
just mean
content?
bringing creators onto
Well,
Facebook at all.
I think all they're doing though is moving them from Instagram to Facebook. So it's not like they
Exactly.
don't already have that content in their network or ecosystem. So no, I don't think it's necessarily that. And frankly, what we've seen now with Meta, going after Moltbook and all these other things, like my big question is, how many agent creators are there going to be a year from now or 2 years from now? Maybe they're going to juice up the Facebook platform with these people or things, to try to get more distribution rather than where the real creators are hanging out, which is really on
Right.
Instagram, of course.
The other big story I wanted to get your take on is we've reported at the information how OpenAI has been shifting their shopping strategy or their approach to e-commerce, and where their ambition was once having everything in the platform, having checkout inside the platform. They've moved away from that now, and they've sort of given up some of that. Did that move surprise you at all?
No, I thought that it was definitely too early, for consumers in general to know how to buy anything through an agent, right? Google Shopping launched in 2006. It took like more than a decade for people to know how to use commerce on the internet. And even though we live in Silicon Valley, and I'm building all kinds of bot armies and agents that run my daily life here, I'm from Texas. My friends and family are simply using GPT and Gemini and all these things just to like ask random questions. So they don't think they yet understand all the different use cases. And frankly, OpenAI now, as we've seen, is definitely having to lean into their enterprise stack much more than their consumer stack in terms of everything that they're doing to go to market. Fiji commented this week, like, we have to end some of our side quests so we can focus on where the real revenue is. And right now, the real revenue is in the enterprise layer. It's in
Right.
AI helping people be more productive at work. Commerce will come, but it'll just take some time.
Well, and we just saw today that OpenAI is doing another acquisition to help beef up their Codex play, which, to your point, I mean, it's another data point to suggest that they really just want that enterprise consumer. I mean, I do wonder. You say e-commerce will come. Where do you think it's overhyped with AI? You know, this whole idea of agentic commerce, and where do you think it's actually realistic that we will see some of that intersecting?
Well, of course, as I'm asking about where I should travel to, it should start letting me buy airline tickets. They're like easy, low hanging wins, I think, in the world of commerce. Commerce is so broad. When it comes to shopping for things like clothes or everyday, face cream or things like that, I think we'll get there. I think it will be human to agent, and it'll definitely follow exactly what it is you're talking about and what it's inferring that you want to buy. But over time, I'm excited for when it can even be agent to agent. My agent is just doing things for me and getting my and not even asking me. I've given it a budget. It's checking out on my behalf. I think that there's a world where also OpenAI or Claw or any of these things are telling me what I should be buying before I even ask it. And so those are like the sequential layers of where commerce will head, but it'll start just like ads did first of all. The ads were not really well targeted. They kind of were like trying to infer what you were thinking or wanting to do, and then over time they've gotten very very good and very very targeted. And as some of my friends say, you can just buy everything you post to me on Instagram. I like it all. They know
Right.
me that well.
Right. Last question for you, Britt. I just want to go back to the creator story for a bit because it's kind of interesting to me. We saw this deal today. Tubi and TikTok have signed a partnership, and they've done some work together in the past. But the broader question I want to ask you about is the creator to Hollywood pipeline. I mean, this is something that we've tried to explore on the show. Do you think that that pipeline is healthy? Do you think it's going to get more popular? Do you think that creators are just hopelessly aiming for a shot in Hollywood? They're never going to get it. I mean, how do you see these two worlds mixing over the next couple of years?
I mean, I've been represented by traditional agents, Hollywood agents before, so I have a little bit of a peek into their worldview, and they certainly do have an entire unit now that's set up to find digital talent and bring them in. Typically, those deals look much different than someone rose up on Instagram and instantly got a movie deal. I think you're seeing it right now, mostly in music, right? People are getting really famous with their songs on TikTok and YouTube, and then they're starting. And Justin Bieber, of course, was the original creator there. So I think it will happen. It doesn't translate as well in every category, though. Music is one where you can really command an audience pretty quickly online. Film is much different, right? You don't just get cast in a movie after through your Instagram. So I think that will be much different. And the rest of most of creators are not movie and film stars. They're
Right.
interior designers. They're pool cleaners. They're like niche industries that don't necessarily translate to Hollywood. So I still think it'll be a part of Hollywood, but a minute part, maybe 20%.
Yeah, I always think about those actors who are famous now, who I've seen interviews with them, and I'm escaping which ones have said this, but they've said, "Save your face." Don't do every commercial that you can. Don't do every social media reel that you can. Just save it for the big break. And unfortunately, in this volume game, that's getting harder and harder to do. But it's certainly something to watch. Britt, I want to thank you for coming on. That is Brit Morin, co-founder and managing partner of Offline Ventures here on TITV. Canva was one of the most closely watched pre-IPO companies a few years ago. If timing was tough back then, today it's even harder with even bigger IPOs like SpaceX and OpenAI that could take a lot of oxygen out of the IPO market. The Information's financial analysis columnist Anita Ramaswamy argues in her piece out today that Canva was smart to hold off. I want to bring her on to talk all about it. Anita, welcome back to the show. It's great to have you here.
Always a pleasure.
So Canva played it so smart, you say.
Yes, I
Why is
think
that?
So Canva is one of those companies. So it's a design software company, and right now the software market is going through a lot. We've all heard about the SaaS apocalypse, and Canva is one of those companies that a lot of investors had their eye on for a while as being a potential IPO candidate. And so we saw Figma, which is another sort of similar company with a different customer focus, but also a design company, go public, and their stock rocketed the first day last June or last July when they did their offering, and then it immediately started dropping. And so the core argument and the fundamental thesis that I put forth in my recent column about Canva is that they were actually smart to wait to go public because even though this fanfare and this hype was building for so many years, the decision to wait means that when they actually do start trading and when they do take the leap, their shares are much more likely to be stable.
Now, is there anything different about Canva and Figma's businesses? It's the same general category, I know, but is this the exact same type of consumer or customer that they're going after?
Not exactly. So I would say the biggest difference between Canva and Figma that is the most noticeable is just the difference in size and the difference in the revenue size. Canva was around 4 billion in ARR, 3 billion in actual revenue in 2025. Figma's revenue was much lower, closer to 2 billion. And, if you look at the two companies, they are serving really different customer segments. So Figma has about 13 million monthly users. Canva has a lot more. And Canva really got its start in the consumer market. It got its start, selling I mean, both of them operate on this sort of like freemium model, but Canva got its start giving its product and selling its product to individuals, to small businesses, to companies that are a lot smaller. Figma has always been really focused on selling into larger enterprises. And so that's where the difference in their customer base comes. And then, of course, like a classic tech story that we see with so many companies, both of them are sort of pushing onto each other's turf at this point.
Right. It's kind of funny. I do think about so the SaaS apocalypse is very much here and now, at least in terms of what the market is saying. I sort of think about whether a consumer focused company or an enterprise focused company would be more protected in this design story from the SaaS apocalypse. And I know Figma has, they've got the enterprise story, but Canva, I mean, we've seen, even with companies like Notion, I mean, when you have a community that really gets around a product, sometimes it can be sticky.
Yeah, absolutely. And it's a little bit counterintuitive, right? Because I think in the broader market with AI right now, you're hearing this narrative of like Anthropic has focused on the enterprise, OpenAI has focused on consumer. And I think investors that I've talked to have seen a lot of promise in Anthropic's enterprise focus right now. But in a roundabout way, it's sort of the opposite story if you think about Canva and Figma, because Canva has these users who, at the end of the day, the likelihood that they're going to go and use an AI tool to vibe code their own design tool or to really do something complex using prompting is unlikely. And I talked to several marketers, I talked to some designers for this story who told me that they really like how easy it is to use Canva, that the interface is simple. And they like the level of control they have too. So I thought one interesting thing was one of the marketers I spoke to said that, she every once in a while will noodle around in Figma. It's a lot harder to use. But, the other thing that she doesn't like as much with some of the platforms that are just vibe coding platforms or even just going to ChatGPT or going to Claude is that she doesn't have that control. She has to prompt every single time she wants to make a change. And so I think Canva has really found this niche in users who are not the most AI native, they're not the most cutting edge necessarily, or they don't want to be, but they prefer that simple user interface. Whereas Figma tends to be used for a little bit more of complex design tasks. So that would be, your UX design, your web design, whereas Canva is used really heavily by marketers, people who want to post on social media. And I think that makes them a little bit more resilient to this AI platform shift. Because if we see a lot of people kind of switching their workflows over to things like ChatGPT and Claude, it's less likely, in my opinion, that those users are going to switch off of something like Canva.
Right. Did you have you I don't know if it's even launched. I saw that the Figma shares were falling yesterday and they continue to fall today on Google's new AI design tool, which I mean, it's yet another data point to show that these bigger companies are uh, I mean, they're going to try to throw everything they can at it. It I wanted to also ask you about the IPO market though, because this is sort of a separate story here. You mentioned in your story, we've got SpaceX and OpenAI and probably Anthropic coming down the pipeline. What are the bankers telling you about how Canva would fare up against issuances like that?
So, to your earlier point, of course, it is a highly competitive space, and the Google offering, kind of came out of left field. But at the same time, I think a lot of big tech companies have seen what Canva has done, seen the fact that they've been able to be profitable for 8 years, and sort of looked at that story and are seeing opportunity there. I think there's a big difference between, Canva versus Figma, and that comes down to valuation. If you look at Canva, where they last raised money at a $42 billion valuation, that multiple is close to like 10 times. Figma actually went public at a much higher multiple of revenue. And so, that difference is kind of important and notable. And when I talked to bankers, a lot of them were, the sentiment was about the valuation. And at the end of the day, Akash, it comes down to the price that Figma or Canva decides to go out into the market. And so, it is a tough time, and there are plenty of other offerings that are going to go to market. But I think at the end of the day, investors will assess Canva on a standalone basis. What it's really going to come down to is that IPO priced, and is it pricing in the future risk and the potential for AI to eat away at its business long term?
And so what do we know about timing insofar as what Canva is thinking? Are they still looking to go public this year, or next year? What do we know?
So the news that I reported in my column is that Canva is planning on an IPO next year at some point.
Next year. Okay. Well, feels like it's been next year for the last 3 years straight. So I'll believe it when I
They
see
actually
it,
take the
is what
lead.
I always say. All right. Well, Anita, I want to thank you for coming on. That is Anita Ramaswamy, our financial analysis columnist here at The Information. Our next segment is with our sponsor, Nebius. It has been a big couple weeks for the NeoCloud company. Nebius announced two mega deals, a $2 billion investment from Nvidia and a $27 billion infrastructure deal with Meta. To top it off, Nebius is raising $4 billion in debt. That last announcement pushed the stock lower, but shares are on track to end the week in the green. I talked about all of that and more with the company's chief revenue officer, Marc Boroditsky. Here is that conversation. Marc, welcome to the show. It's great to have you here.
Gosh, it's a pleasure. Thank you so much for having me.
So, you guys have been real busy lately. I mean, if we just recap some of the headlines from the past week or so, I mean, you had the Nvidia investment, you announced the contract with Meta. This week, we also, well, certainly GTC has been there in the background. You also had the $4 billion debt raise that was announced this week. I want to start with the most immediate news, which is the debt raise. It's the latest headline. Why should investors not be afraid of this? We've seen this debt story play out a couple times before with neoclouds.
Well, this is a little bit different than some of the other debt stories that have been presented. First of all, this is a convertible offering, so inevitably this becomes a part of our overall equity stack. And this is also reinforcement of the commitment that we've already made about being able to support the 15 to $20 billion in capex that we need in order to be able to support the growth plans that we have. So this is, I think, a very positive story from that standpoint. We're delivering a healthy form of financing to support ultimately the AI cloud growth plans that we have.
Now, the Meta contract is really interesting because here, this is a story of a big company saying, we're building out our own facilities, but we really need help right now in the short term. And so my question for you is, what gives you reason to believe that a big customer like Meta would stick around with Nebius after they're done constructing their own facilities?
Actually, we anticipate that's likely to be the case in the entire category. I mean, inevitably, if there was sufficient capacity available to them with their own construction, they'd be pursuing that. So our business model is not really dependent on these kinds of opportunities. We recognize and respect that this may be a moment in the market. And it's really a privilege to have this kind of a customer, a very unique one, because it's at the end of the day, a very scale, sophisticated, highly capable customer that in many respects is endorsing our platform. This is the second purchase that Meta has made, and they are very satisfied with us as a supplier, and you can see it by the commitment they're making here. And I think we will, in the fullness of time, probably as you forecast, see this relationship. Maybe it repeats, maybe it doesn't repeat, but ultimately, we're actually angling for the broader market, which we see as the um, thousands of customers that are out there that need to fulfill their AI requirements, and we are pursuing that in earnest.
But is it not true that it would be a bit cheaper in the long term for customers like this to build out their own facilities?
Cheaper in the long term, yes, but at the end of the day, they today don't have the ability to supply their immediate needs. I can't speak to their specific circumstances as to how they arrived at that, but um, the need is here, and the opportunity is here, and the value that they're going to derive from this probably far exceeds the marginal cost exposure that they have by not building it themselves.
Right. So you're at GTC this week, and we've seen the fast pace of announcements that have been coming out of the conference. Certainly on Monday, we had Jensen Huang's keynote. We saw more details about the Groq chip, about Vera Rubin, and about the Feynman chips as well that are coming even further down the line. My question for you, Mark, is how you think about balancing this fast pace of development of new chips with the likelihood that, you probably prefer long contracts, and it's better to you have a contract with a customer that is years long. But that customer might come to you and say, "Hey, look, there might be a new chip coming out 6 months from now. I don't want to sign with you for 2 years."
I think the important dimension that's not immediately visible is the fact that there's a lot of different workloads. There's customers that are still building on H's. As a matter of fact, we've got customers right now that are literally telling us, we'll take all the H's you can give us. As a matter of fact, I was talking yesterday to a pretty traditional industrial customer, very large scale supplier of capabilities to the oil and gas industry. And they told us that they're currently really heavily invested in H's. So you can recognize that still earlier generation chips have a strong viability in the workloads that were actually well suited to them. Now, of course, you're correct that this sort of ongoing delivery of next generation chips represents an opportunity for us to help customers to deal with more sophisticated workloads, more sophisticated performance requirements. And we are very committed to making sure that we can deliver the most recent capabilities and help our customers to incorporate them in their plans. As a matter of fact, a lot of the conversations we're having are customers that are telling us, today we're on the Blackwells, and we are going to shift to Grace Blackwells. And how are you going to help us to make our journey to the Veras? And we're having interesting conversations about how we plan together so that we can partner with them to meet their ongoing expanding requirements, not just in terms of just the number of chips, but the kinds of chips and the kinds of workloads that we can support.
We've reported here at the information on some of the challenges there are with any transition to a new chip, and we've reported with the Blackwell chips there was sort of an onboarding process there. What challenges do you anticipate helping customers migrate to the Rubin family, and how do you address those?
We address those by having the best GPU and AI engineers on our staff, what we're really well respected for. And I hear this all the time when I ask customers about their renewals and why they're staying with us and why they're expanding. They tell us all the time, beyond the technology that we provide and the experience we have, that the engineers that we couple with our platform are the best they've seen in the industry. Actually, I had a customer yesterday, a well-known financial services customer, tell me that the POC they just completed was pleasurable. They said that they've never experienced it, or their team said that it was a pleasurable experience. And I think that's the marquee difference that we have in comparison to other players out there is that we're bringing the expertise necessary to work with this very sophisticated technology. You could think of this as a forward engineering capability to help them to understand how they can actually migrate to the new architecture, what they need to be thinking in terms of their workloads, their applications, their services, and how we can help them to make the migration.
How do you think about which customers get which chips? Because we know that all of these chips are in high demand, and the Vera Rubin chips will, when they're rolled out. I mean, there's only going to be so many of them to go around. It's hard to implement, as we said. We got the Groq chip as well. You are kind of in this decision making seat where, in some cases, demand is so high you have to choose. How do you go about making that decision?
Very good question, and it's actually an astute observation. It's not an easy one, candidly. I've never been in a position where we have to say no to customers, so this is a new experience for me overall. And I do believe that this is not a sprint; it's a marathon, and we're looking not just for the transaction that's in front of us. We're looking for the long-term partnership. We want to know that we can help customers not just with what they need today, but be able to be a reliable, strong, respected partner that they can turn to as their needs expand and their growth depends on having that kind of access. So we're looking for customers that follow a set of principles, or actually we are looking for them by applying a set of principles where we are first and foremost servicing our existing customers. And then second, we are looking to help enterprises start their AI journeys. Third, we're looking at software vendors that are looking to transform their businesses to become AI led. And then we're working with the AI natives that we already have the right to win and that have been the hallmark of our success to date.
Right. Marc, any plans to offer customers access to chips that are not made by Nvidia? I'm thinking about Google and Amazon that have made some big strides, AMD as well.
We're always looking at the alternatives and remaining technically astute as to what's going on in the market. I'd love to say that we are a market maker, but the reality is that we're a market catcher. We are relying on the demand that's out there. We're relying on what customers are asking for. We're not in a position to transform that demand. So today we are paying very close attention to what people are asking for, and today that priority is completely NVIDIA driven.
So they're not asking for AMD or for TPUs.
When we hear about TPUs, as an example, 99% of the time it's a former Google team, and unfortunately, Google alumni does not make a market. We're if once we start to see it more
One day it could. You never know.
one day it could, yeah, yeah. There would be a massive diaspora from Google
Yeah.
to happen. But if we do see the pattern, yeah, we'll definitely have to consider it. And we're
Right.
very demand driven today.
So last question for you, Marc. How much do depreciation schedules for these chips come up in your conversation?
Less and less. The reality is that it's the pace of the innovation that's taking place that's driving the term that people are typically looking for. So I've got highly innovative companies that are looking for shorter terms. And then I've got companies that have more reliable and consistent workloads that don't want to have interruption in their supply that are looking for longer terms. They're all recognizing that supply is actually driving price, not the underlying accounting.
Okay. And what do you mean by, I mean, expand on that a little bit. Just explain what you mean by that.
Well, the reality is there's insufficient capacity in the market to meet the demands that people have. So price is actually being driven by the amount of capacity, not whether or not it's a 4-year, 5-year, 6-year, 7-year depreciation schedule.
Got it. Great. Well, Marc, I want to thank you for coming on. That is Marc Boroditsky, the Chief Revenue Officer at Nebius here on TITV. The AI supercycle has had big implications on the debt markets, not the least of which has been hyperscalers issuing loads of new debt that investors have been eager to eat up. On the other side of the spectrum is debt for enterprise software companies that investors have not been as excited about. This week, we saw the latest data point to that effect. A number of big banks halted a debt deal for Qualtrics totaling $5.3 billion, according to Bloomberg. I want to bring on Ross Gerber, President and CEO of Gerber Kawasaki Wealth and Investment Management, to help us break it all down. Ross, welcome to the show. It's great to have you here.
Yeah, thanks for having me.
Okay, let's talk debt. So,
Yes.
okay, when we hear that a bank halted a debt deal, for people who aren't as well versed in that, what does that mean?
Means they couldn't raise the money. I mean, it's pretty simple. So, investment bankers get paid a commission to sell deals. So on a $5 billion deal, you're talking like $100 million. It's big commissions here. So they do everything possible to sell this debt to their clients because they get paid to do that. And so when they halt a deal, that's pretty rare, and it's not a good sign, obviously, for that issuer.
Okay, and so they halted. They basically said we're not. I mean, we sold maybe 2 of the 5. Let's say we can't sell the rest. We're just taking the hit on it.
Right, exactly. And
Okay,
see, a lot of these deals oftentimes are predicated on public, like private equity cash out, where they'll like invest in a company and then throw the debt on it and then take a dividend for themselves to pay themselves back and then sort of saddle the company with this debt. We're actually customers of Qualtrics, and it's a very good company, and we have contracts with them. We can't just like stop paying them. So, it's not like they're in any like financial issue. It's about, what does this look like 5 years from now when the debt's due, and do we want to hold that much debt? So it could be an issue of over leverage as well, where they're just being a little bit too greedy on how much money they're trying to borrow.
okay. So now, what does this? I want to broaden this out. I mean, Qualtrics is one company.
Right.
What are you seeing in the debt markets broadly for these enterprise software companies whose, I mean, I'm thinking of some of these companies that went private 5 years ago. These PE firms had to lever up to buy them. What's all that debt trading at these days?
Well, that's where it gets pretty ugly because, the class of 21, we call it, whether it be the SPACs or the debts or the IPOs of that time, are probably the worst performing investments that we've seen. And a lot of that was due to the excessive speculation of that period of time, and also incredibly low rates. So let's say you did a deal back in 21 where you borrowed $1 billion at, let's say, 5 or 6%, but now that deal looks like a 10 or 12%. So you're at 50 cents on the dollar if just off interest rate changes. You see what I'm saying? And then you have higher risk now as people perceive those businesses as weaker in the future, and then they might trade even lower, 25 cents on the dollar. So you see substantial discounts in markets like in the BDC market, and then in the private credit market where there's lack of liquidity. Where there's liquidity, we see much better deals, much better rates. So if you're an investment grade type issuer, or if you have a very solid financial backing, you're still able to borrow money. The capital markets are certainly open for business, but as risk gets scarier for bond investors, they're just walking away from this illiquid high risk stuff.
So you have this kind of double whammy. You have both the enterprise values coming down, and you have the interest rates coming up. So my question is then, how does this play out then for the enterprise software companies whose debt is being traded? I mean, some of these deals will have to be refinanced. What do you think this turns into? Are these companies have to restructure, or what happens?
Well, right. That's what happens if you can't borrow. Now, in most cases, the companies are multi-billion dollar companies that aren't just going to go BK. So it takes a lot to go bankrupt. You can ask Donald Trump. He's done it a few times. And so, these companies, will probably survive. But what it happens is it's just like a liquidity crunch internally in those companies. So what happens is they go, okay, we got to pay off this debt one way or another. And that's where you see the layoffs, the cutbacks. They have to increase cash flow to cover interest and principal payments. And then they end up refinancing at a much worse deal than they had before, which then hits earnings, because if I'm paying twice as much or 3 times as much in interest, that comes right off the balance sheet, so it's be careful what you wish for. When you have 0% interest rates, people just borrow, borrow, borrow. We saw it in the real estate market. That's coming due right now. For 20 years, people borrowed at 3 and 4% mortgages. That's coming due now at 6, 6.5. And real estate deals are going down at 10, 11, 12% yields now. So imagine if you're a high risk borrower, you're looking at maybe 14, 15%, and then a war breaks out. So this is a really tough time to get liquidity. And I would say there's a lot of money out there. So we're not in a recessionary environment. There's cash out there, but there is risk aversion from investors. Investors want safety right now, and that makes it real tough if you're over levered.
What are you buying right now in the debt market?
In the debt market, I'm mostly actually buying a lot of foreign debt. I'm getting money outside the United States and trying to get currency diversity. I like foreign debt and, in general, that diversification for my firm makes a lot of sense. I buy a lot of short-term high yield of high quality issuers where I can get, 5 or 6% on a short-term high yield right now, and they're high quality companies that aren't going out of business. So I'm
And
looking
these are tech companies, or these are all different sectors?
industrials, it can be a lot. It's not tech companies, so there's not a ton of debt of the tech companies that I really want to own compared to, solid industrial companies where I can get a nice yield and have liquidity. So the main thing that I look for as an investor and how it works at my firm is we look for liquidity. We don't want to get stuck, like these BDCs drop, 50% in the last 6 months.
And BDC stands for?
Business development corporations. These are loans to, higher risk businesses, but they're at the same spectrum of private credit. And so when you're in the high risk area, we've seen a substantial decline in value. You can get a ton of yield if you're willing to take risk, but that's not what clients want right now. They want safety and liquidity. So buying short-term bonds of, you can buy Apple bonds or, Disney bonds or Netflix bonds, things that that's going to pay off, that might mature in the next couple of years and still get a very nice yield. So investors want that, and they want liquidity, and that's where you have a lot of liquidity. And then on the risk spectrum, there's no liquidity.
Right. So let me ask you this: watching to see how the SaaS apocalypse plays out, we've got these big, mega AI IPOs coming down the pipeline. Investors will get to see a closer look, hopefully, at the financials of these companies, and then they'll decide if all the hype is worth it. Do you think that those AI IPOs could actually be good news for the SaaS apocalypse in the way that people actually come back to enterprise software companies and say, hey, I mean, they actually have cash flow. Why were we knocking them so hard?
Well, I don't know if investors look at it that way. I mean, like a good company earns a profit and they return those profits to their shareholders efficiently and manage their finances efficiently. And so if I'm a SaaS company like Salesforce with a really solid business and cash flow, I just have to manage my business right and the stock will come back. AI is not going to replace Salesforce tomorrow. There's a ton of limitations. Just today I was like, I wish I could just say into my computer, pull up all my older clients above 65 years of age that have an allocation to equities over 65% out of my entire book. Can you just pull that up for me? And it can't do that right now. And so there's just a lot of time before AI is effective as we want.
I'm with you, but that's not the narrative right now.
It doesn't matter what the narrative is. I use it every day. I can tell you its limitations right now because I trade billions of dollars. So I can tell you right now, AI is a long way away from taking anybody's job. That's for sure. Okay, it's actually fairly inaccurate in its analysis, especially on financial, data and such. So, I'm still using my Bloomberg, trust me. So,
Right.
what I think it is that companies have a very small window not to be disrupted. They have a small window here, maybe the next 12 months to build agents that make Salesforce 20 times better because I'm not quitting my Salesforce. I've invested $1 million into Salesforce. You know what I mean? It's like it runs our business. It doesn't just go away because AI comes around and says, oh, we'll manage like literally millions of pieces of data for you without a mistake.
Right.
So I think that if these companies run themselves correctly, the stocks will come back up and there's value there. But I also think companies like OpenAI and all these private companies are vastly overvalued, and then going public is going to be challenging for these companies
Right.
at the valuations that they pumped themselves up to without any, buyers or sellers. You know what I mean? So the public markets aren't so nice.
Right.
You got to come out here and fight the
So
battle with
this
guys
this
like
could
me.
benefit the Salesforces of the world in the as
Well, it not per se benefit them because it does take capital away from those stocks into new stocks, remember. So,
Right.
it's like the less choices I have, the better it is for Salesforce. So if I got 4 more great tech stocks to buy, Salesforce might come down the list further, you know what I'm saying? So it's not necessarily a benefit. But I think investors have to think long term. The AI ecosystem is amazing. It's just an amazing opportunity. It's a once in a lifetime opportunity. People who don't see it, I understand, because it's oftentimes hard for us to see past a few years. But I've been a tech investor for over 30 years and in the public markets and ever since I've been a child. And I can tell you this for sure. When we look out 5 years from now, the world will be vastly different. It will be incredibly profitable companies that adopt AI technologies and the infrastructure behind it, like your sponsor Nebius, the numbers out of Micron or Nvidia or Microsoft. This is just the beginning.
Yeah.
And that's what I'm trying to say. Salesforce is going to get 20 times better in the next 5 years.
To talk about the memory chip crunch, then, I mean, we saw the news this week about Micron. Micron shares are up big time this year. I mean, I don't think there's any disputing that people need their product, but the supply chain crunch is something that can't be ignored. How do you think about when that might return? These short-term fluctuations. What do you think?
So my basic feeling right now is that the next 2 years will be pretty competitive for every piece of equipment, machinery, data center. Maybe 3 years until there's some supply and demand balance between the demand for infrastructure and the supply of the materials for this, whether it be chips or equipment or land or just getting approvals from cities. I think people are underestimating the desire for people to have all these data centers in the United States, for example. And so, there's a lot of things that have to be built. I did this with AOL back in the 90s. The internet takes off and everybody's like, whatever. But we had to lay cables, and we laid all these cables for a long time. And a lot of those companies went bankrupt, but the internet thrived and built the Amazons and the Googles of the future. So there will be new Amazons and Googles built over the next 5 to 10 years. And that's what we're looking for as a firm at GK and in my fund. But I think investors just need to be patient, look for opportunities like Micron. I mean, the numbers are insane. So,
yeah, because nobody can, there's not enough of it to go around.
I'm just doing my numbers on this thing, and I'm like, and I was thinking maybe $30, $35 a share this year. Now I'm going 40 or plus. And I go, why doesn't it deserve a 20 PE? You're at $800, So, I just think there's just this denial in the market of how profitable this is for certain companies like Nvidia or Micron. And these companies are printing money right now, and it won't last forever. But I think the next 5 years look pretty good, And
so when do you get out of the stock then? I mean, a company like this, it's not going to last forever, and it's hard to. I mean, when do you sell? At what point?
Well, it's not that you sell; it just reaches more of an equilibrium where you're not growing 1,000% year over year.
Okay.
These are, I mean, come on, I'm trying to grow my company 20 to 30% a year. It's, it's challenging, and we're, I don't know what we're worth, you know what I mean? But when you think about $100 billion company trying to grow at 20 or 30% a year, and they're doing 50 and 60% a year in revenue growth, I mean, this is insane. And people just don't this is incredible amounts of money being made and spent. And so, I think it'll reach an equilibrium in the next 3 years or so. And then these companies will make a considerable amount of money, but it will be much less growth. And then you have to look at the PE ratios. But these companies are not NVIDIA's at 18 forward PE. They're not even close to what the PE ratios should be in these companies. So when you say, what would the equilibrium PE for these companies be 5 years from now? Maybe it's 20 to 25, and they don't even have those PEs now.
So it's going higher.
So I'm investing hardcore.
Got it.
People pitch me all the time on all this stuff. I say, all my money's going into this stuff. I'm sorry. I don't want to buy this. I don't want to buy this. I'm putting it all into AI. I'm sorry.
Great. Well, Ross, I want to thank you for coming on. That is Ross Gerber from Gerber Kawasaki here at The Information. That does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank you all for tuning in. We really do appreciate your viewership. Make sure to subscribe to The Information on YouTube and follow us wherever you get your podcasts. I am already excited to get to our next show tomorrow. Have a great rest of your Thursday. Bye-bye for now.